So let's start applying our wealthy mindset here to this average American household scenario. And remember, before we get started, the two things that wealthy folks focus on creating relentlessly are cash flow and leverage. Okay, so we want to focus on creating those two things. And so what we see, and again in our scenario here, is that we had $5,000 worth of income coming in and $5,000 going out. So we have zero cash flow. So first things first, we need to look at where can we create some leverage. We know that if we take our $5,000 and send it to the loans, we lose all the leverage there. We can't create leverage doing that. The only place that we can create leverage in this scenario is right there in that line of credit. So applying our wealthy mindset, what would a wealthy person do with this scenario? Is they would start taking all $5,000 of this income and sending every single nickel of it, every single month, directly to the line of credit, okay? And let's take a look at what it does to our numbers here. And you know what that does, by sending all of your income to the line of credit, it eliminates that $600 payment. We no longer have to account for that because all $5,000 going in there throughout the month will cover that payment, right? It'll cover that requirement, so you no longer have to account for that. We can take that $600 and add that to our cash flow number. Also, that now that we've learned a little bit more about leverage and more about bank savings accounts, okay, and how we don't really get a lot of leverage there. Okay, we're going to take that $1,400, we're going to add that number directly to our cash flow. In this scenario, we're trying to get rid of the debt. So we're going to stop leaving money in the bank savings there and put it directly into our cash flow. And so what we've done here is we've done a little financial shift and we've changed our numbers here a little bit. We still have the same $5,000 worth of income coming into the house, but now we have a $2,000 cash flow number and $3,000 going out in expenses. So we have $5,000 coming into the household, we have $3,000 going out still with all of our expenses, but we now have a $2,000 cash flow number that we're gonna use to start knocking down our debt. And so bear with me here, okay? Let's take a look at what this does to our line of credit. Let's run the numbers here. And a critical point to make with this is you wanna think of your line of credit as your new checkbook. Okay, you're gonna use that as your new checking account at the bank. Okay, you're gonna pay all of your expenses using the line of credit instead of sending checks from your bank account, okay? And so let's play this out on our line of credit. So month one comes rolling in and you got $12,000 balance on this $15,000 limit card, okay? And so you got a $12,000 balance and you're gonna hit it with that $5,000, it's gonna knock the balance down to $7,000, okay? Then you're gonna use the line of credit to pay for all of your expenses. So you're gonna pay your mortgage, pay your car payment, pay all of your lifestyle expenses using the line of credit. So $5,000 in and $3,000 out in expenses. And what we see is a debt reduction by our cash flow number. So in month one, it went from $12,000 balance down to 10. That's fantastic. Month two comes rolling in, 5,000 in, 3,000 out, down by our cash flow number. Month three, 5,000 in, 3,000 out. So went down by our cash flow number. And most people, when they're seeing this scenario for the very first time, they're like, well, Mike, you know, I can't do that. You know, what if there's an emergency or something happens? You know, if I send all my money to the line of credit, what if something goes wrong? And here's what's the beauty of doing the strategy this way. Like instead of just sending the extra money from your savings to the line of credit, if you do it that way, you have no leverage. Okay, your money's gone to the bank and you have no leverage. You leveraging the line of credit here, you have this available credit, right? You know, in month three here in our scenario, you have $9,000 worth of room on this line of credit that you could use, right? You have the leverage. So if something did go wrong, you would be covered, okay, versus just sending the money from your bank savings account. This gives you the leverage. This gives you the safety net to actually get all of your money working for you. Okay, so, you know, no emergencies here in our scenario. So barring emergencies, this will go down by our cash flow number every single month. And simple math, $12,000 going down by 2 every single month. It would take about 6 months to pay down this line of credit using this strategy. And again, just shifting the way that we're using our current money. And so now that we've paid off the line of credit, you know, we've been able to clean up a little bit of the debt here. You know, what can we do now? All right, what's the next step here to eliminating all of this debt? Well, you remember that expensive amortized mortgage that you have? Let's take a chunk of that amortized debt and move it over to the simple interest line of credit. Okay, transforming the interest, you know, you're paying on that debt, making it much easier for you to pay off. So again, now that you have this line of credit paid off down to zero, you could take that line of credit, you could write yourself a check off that line of credit and send it all, principal only, 12,000 bucks, directly to your mortgage company. Essentially grabbing a chunk of that amortized principal there and bringing it over to the simple interest line of credit, okay? And then from there, we start running the velocity banking strategy where we got all $5,000 of our income hitting this line of credit. We still got $3,000 going out. And so we put another $12,000 onto our line of credit. Okay, it's gonna go down by our cash flow number every single month. So it's gonna go down by $2,000 in this scenario. It would take 6 months to pay this balance down to zero. And guys, that is $12,000 worth of mortgage principal reduction. Okay, if you remember from the beginning, and if you go back to this example here, imagine being able to do a move like this at the beginning of your loan. If you were able to take a line of credit and grab a chunk of amortized principal and bring it over, is that when you prepay the principal, okay, this interest here, if you were to send in $12,000 on day one, this interest here in the box, you're no longer required to pay it. When you prepay the principal, you no longer have to pay that interest. Okay, you only have to pay that interest if you stretch it out over those 4 years. If you prepay it, you're no longer accountable. You jump right to 188 on your amortization, and then it keeps going from there. But the interest that you jumped over, you don't have to pay it. Guys, that's a huge savings. Okay, and that's why we believe that this money secret is truly the key to financial independence. And a lot of people will ask here, Michael, what about the interest on that credit card? If I'm using that credit card for 6 months, to knock down, yeah, I'm saving that huge amount of interest there. What about the interest on that credit card? Well, here's the formula for that. And so if you wanted to run the numbers on that, if you carried the $12,000 balance for the whole 6 months, even though you're knocking it down by 2 every month, over the course of, if you carried the 12 for 6, you would pay about just under $1,300 in interest on that credit card, carrying a $12,000 balance for 6 months at the 21% interest rate. Okay, but again, comparing that to, and that's again for $12,000 worth of principal reduction in your mortgage. Okay, it could be your student loan, right? But in this case, your mortgage. Okay, to get the same $12,000 worth of principal reduction in your mortgage, just sending in the monthly payments, it took us 4 years of payments. It took us $57,000 worth of capital, and you had to pay $45,000 worth of interest to get the exact same principal reduction in your loan. So you tell me, what would you rather pay in interest to get the same exact principal reduction? Okay, $1,300 worth of interest, okay, in 6 months, or $45,000 worth of interest in 4 years. Okay, that's a big time and money savings, folks. And again, you could rinse and repeat that process every 6 months. Pay down the line, grab another chunk of amortized principal, and bring it over to the line of credit. Bottom line is, by rinsing and repeating that chunking process every 6 months, barring emergencies, this average American household would pay off their credit card, the car loan, and their 30-year mortgage in about 6 years, leveraging this strategy. And the cool thing about it is we were able to break the shackle of debt, okay? And they were able to do it without sending in extra payments, without refinancing, without increasing their income, or even being forced to live on beans and rice. They didn't have to go without, simply started using this velocity banking strategy. And we're 6 years down the line now, and the beauty of this is now that we've eliminated the mortgage, we've eliminated that mortgage payment. So we can take that $1,200 and add that directly to our cash flow. And 6 years down the line as well, we've eliminated the car loan, so we can take that $600 and add that to our cash flow number as well. And so we got the same $5,000 worth of income coming into the household, but now we only have our lifestyle expense, which we kept exactly the same. Okay, and we have a $3,800 cash flow number. Now, I love this quote by Bob Hope. Okay, he once said that a bank is a place that will lend you money if you can prove that you don't need it. And here at this point in the scenario, it's very easy to see that the bank would offer you a line of credit increase. They probably offered it to you before this, since you've been using that line of credit effectively. Guys, banks reward this kind of behavior, right? If you're a good saver, when you save money at the bank, they're not going to reward you with lines of credit. But if you start paying down lines of credit quickly, they're probably going to offer this to you much sooner. But let's say it took them till now to finally offer you a credit limit increase, because now you've eliminated the mortgage. You still have your job. You've eliminated the car loan. This credit card is a zero balance. balance, it's very easy to see that they would offer you a $10,000 limit increase on your line. And what they're hoping for is that you're going to rack it up, with the liabilities again, so they can start charging you interest again. But now that you have your wealthy mindset, now you know a little bit more about how lines of credit work. You know that they are for assets and emergencies. That's it. So, so what can we do now with this line of credit? Because for most folks, and looking at this average American household scenario, right, for this average family, life is actually pretty good. We've been able to clean up the debt, okay? But we still got one big problem here. One big problem with this scenario. And the biggest problem is that, where is this $5,000 coming from? Okay, in this scenario, you've still kept your job. Right, we kept that the same, and and what if your hours get reduced, your bonuses get cut, or you get laid off, or worse, even terminated, right? Unfortunately, about corporate America, what do we know is that for any reason, at any point, the boss could let you go. So, what would the wealthy do about this? How would they protect themselves from this kind of situation? Well, again, remember, guys, lines of credit are for assets and emergencies. And so now that we don't have any emergencies going on, we've eliminated the debt, let's use the leverage in the line of credit to accumulate additional cash flow producing assets. Now, if you remember at the beginning of this video series, I said that I would show you how to go from living paycheck to paycheck to becoming completely debt free and owning a 7-figure property portfolio in just over a decade. Let's leverage the tools that we have available here, right here on our new chessboard, to create financial independence. So stay tuned. We're going to uncover that in the next training.